You're watching The Money Show on ET Now with me, Mubina Kapasi. This is the destination to help you understand how the latest news and the latest updates around the world hit your money and what does it do to your wallet. And of course, it's the show where we help you decipher what to make of the moves seen in mutual funds and how you should rejig your mutual fund portfolio. Today on the show, we are going to be talking about the series of announcements made by the finance minister in the last couple of days, and we will be trying and understanding what's going to be the impact of those announcements on not just your wallet but also your investments overall. So we'll try to make sense of that, and later on the show, as always, we'll kickstart our Ask the Money Show segment, wherein we will throw open the floor to you, our viewers, where you get an opportunity to send in your email queries, that's with respect to your portfolio, on the Money Show at etnow.tv, and we will get them answered by Mr. Gaurav Rastogi of Kuvera. And that's exactly who I'd like to introduce today on the show, Mr. Gaurav Rastogi, who's joining us today. Thank you so much, Gaurav, for joining us and, breaking down the very important aspects of financial planning at such a crucial juncture as we are grappling with COVID-19 and the different ways in which it has impacted our cash flows. And then, of course, you have the government of India swooping in to sort of alleviate some of that pain. So, Gaurav, has the finance minister done that in the last couple of days? Has she made, it easier for the common man to sort of grapple with any cash flow issues that he or she may be facing?
So two parts, right? I mean, let me break it down to two parts. This question, Mubina. And before that, first of all, thanks for having me here. India as a country, right? Our per capita income is about 2,000 rupees. We cannot print a lot of rupees without hyperinflation, and our tax to GDP ratio is 17%. So, given all of this, there is only that much that a finance minister can do. Do I think that this was the most creative package that has been announced? No, I think a lot more could have been done. There has been a focus on alleviating cash flow issues for bottom of the pyramid through direct bank transfers or for MSMEs. But I think both of them could have been larger. What's missing clearly is any support for industry, for demand generation. And that kind of is what is the most important thing for a mutual fund investor right now. And that was missing from the whole package.
Okay, all right. There's one point, Gaurav, that you as well had identified for us, and, it's something that's worth, talking about, and that is that the finance minister essentially gave a guarantee of sorts for the debt of NBFCs and HFCs. And that's a point you highlighted. Why is that important? I mean, when the government is guaranteeing the debt of housing finance companies and NBFCs, what sort of repercussions and what's the impact on mutual funds as such?
This is actually one of the few things which is definitely a positive for mutual funds, right? Governments have guaranteed debt before, right? I mean, they are at some point they have to become the lender of last resort. The Fed has been doing it for a very long time. In fact, in this crisis, Fed is actually buying IG bonds on its own balance sheet, right? So we have not gotten to that stage, but what the government has done is they're basically saying that any bank who wants to buy NBFC or MFI debt from the secondary markets, it's mainly from mutual funds, you can buy it and the guarantee will be given by the government. So if the bond defaults, the government will pay. So this is for investment grade paper, but this is really good news, right? I mean, for example, the FT schemes, right? The 6 schemes of Franklin Templeton that got shut have close to 40% exposure to the above sector, right? So there's a 30,000 crore rupees support announced here. What this does is twofold, right? One is that the government is backstopping debt. So they're basically saying to a certain level, we are going to not let these NBFCs and HFCs default. The other thing that happens is because the government backstops it, the probability that the default will happen automatically goes down. It creates a ripple bullish effect in the investors. They also did something very similar for AA minus and below rated financial institution paper, who are also finding it very difficult to raise new money. There, it's a 20% first loss piece, up to 45,000 crores that the government is kind of backstopping. But both of them are very positive news for debt investors, for a sector that had seen some pretty, credit risk sector that has seen some pretty bad news flow in the last month or so.
I think what we'd also like to talk about is the whole Franklin fiasco, because it could be a bit related to something that the government as well had announced. RBI had announced this liquidity measure for mutual funds, and now the government as well announced this guarantee. Just to ensure that we are not, giving investors some sort of false hope, this guarantee, does it mean that, maybe a Franklin type of a fiasco's repeat would not happen or would be prevented?
No. So no. So it does not mean that. What it does mean is that for Franklin, or for other mutual funds, they will find it easier to liquidate some of their portfolios and return cash to the investor. It does reduce on the margin the probability that defaults will happen in this space. But it's this is very focused to kind of where the problem is right now. This is not across sectors. This is not across all debt held by mutual funds. So if there is any other industry where there is where we start finding a lot of stress due to COVID or due to the economy slowing down, this cannot cover that. So it's not a blanket protection in that sense.
That's extremely important to understand, that it's not blanket protection. So, investors should not be under the expectation that, okay, now their debt fund is safe, or, the government is going to guarantee it as such, because my debt fund has invested in, papers of housing finance companies and NBFCs, and the government has said that we will guarantee investment grade papers. It's extremely important to understand that. But I suppose, I think, Gaurav, from what you're telling me is that maybe it will be easier for Franklin, the 6 affected debt funds, for Franklin's 6 affected debt funds to recoup the money and eventually pay it to investors. Do you think that process will become easier?
Process will definitely become easier, right? I mean, because that if that process does not become easier, then this is this becomes a pointless exercise. The whole idea here is a bank can come in now and say, you know what, I am okay to take this risk. I understand that these are risky, even though they're investment grade bonds, but they're still risky. There's a credit risk there. There's a risk of default here. But I'm willing to take this risk because I know that if a default does happen, the government is going to pay me back. So it does make it easier for Franklin Templeton to be able to buy buyers for these papers.
Okay, understood. All right. So that's essentially about understanding this aspect with respect to a government guarantee, if you could call it that, on investment grade papers that are issued by NBFCs and housing finance companies. That is something that debt fund managers do tend to invest in, and which you in turn, of course, do buy units of. And it's important to understand that it would have implications for debt fund holders. Gaurav, do you think now, by the way, is a good time to be nibbling into debt funds? NAVs have crashed, and we are facing this fear with respect to corporates not being able to pay back debt funds. But nevertheless, we always say that you should have some element of debt funds in your portfolio. So I just want to put in one more question. Do you think now is a good time to be holding debt funds then?
Yeah. So see, I mean, what you have to fundamentally understand is that credit risk funds take credit risk, right? Just because you've not seen a default in the past 5 years does not mean the risk goes away. The risk is still there, right? Will it happen today? Will it happen tomorrow? We don't know it. In times of stress, in times of market stress, credit risk funds, some of them, depending on, some of it is luck, some of it is kind of how the manager invested, what kind of risk they actually took on book, will blow up, right? So when we think of it, we think that credit risk funds are too pro-cyclical to the equity markets. Usually defaults and credit risk manifest itself when your equity market is also not doing well. So we don't see them, providing you any sort of down market protection or down market, kind of negative correlation that traditionally people think about debt and equity in a sense that, debt is safer, and even if equity market falls, debt won't fall. But if it's credit risk, then that's not necessarily true. So you have to understand what kind of debt risk you're taking. Second is credit risk funds will, on average, even after adjusting for defaults, as a universe, as a category, if you look at credit fund returns, they will do better than your ultra shorts. They'll do better than your liquid funds and so on and so forth. You will get that extra bump in return, but that will come at the cost of some funds in the universe facing defaults, and that's just part of how the markets work. Just because credit funds take more credit risk does not mean that everyone will get higher returns. On average, the category will have higher returns, but there will be odd outcomes. And this is again no different than how equity funds also behave, right? So you look at a very simple example is you look at Indian data and you look at the past 10 years. One in five or two in five large cap equity funds have beaten the index, but not all of them have beaten the index, right? 3 out of 5 have underperformed just the index itself, right? So it's no different in credit risk funds. This whole idea that people have that credit risk funds are somehow higher yielding, but miraculously as safe as FD, that's the problem. That's the root cause. That expectation is completely wrong. But other than that, to going back to your point now, is this a good point to start nibbling into debt funds? So timing the market is really, really hard, Mubina, and we don't recommend that to try and time the market. But what we do know is that if you had bought credit risk in 2008, 2009, after the Lehman fiasco happened, you would have had some of the best 3 to 4 year returns in credit funds ever, right? So yes, times of stress are a good time to buy this, but don't get into it just because some backtest says that the returns will be good. If you don't understand credit, if you don't understand how to look into a portfolio of a credit risk fund and figure out whether this is something you want to invest in or not, stay away from it. There are other opportunities. Like you've mentioned, credit risk funds have a much lower NAV, but then everything else also has a much lower NAV, right? The index itself is trading down close to 30% from the peak. So that's that we would bet is a better place to start nibbling, right? I mean, or a small cap fund is a better place to start nibbling. So get into credit risk funds only if you understand credit risk. Otherwise, stay away.
Okay, understood. All right. Well, let's do one thing. Let's take on board some questions and queries then. And we've already got a whole host of them. A couple of our viewers now have started emailing us. So I'm going to start taking on board those questions. First up, let's take a query from Veshuk C. Veshuk writes, is it advisable to invest in gilt mutual funds for the next 3 to 6 months, considering massive borrowing by the government? And again, the negative news around debt funds. It's a valid question, with so much uncertainty. One believes that, let's just keep our money with the government. At least it's we're not worried about credit risk over there, because it is at the end of the day something that invests in government securities and government funds. And, by the way, last year, before the crisis, we had seen gilt funds perform really well. Gaurav, what's your opinion on gilt funds?
So gilt funds take something what's called interest rate risk. There's no credit risk because it's a rupee denominated debt, and the government of India can and will pay that money back. It might cause hyperinflation. That's a different story. But so the key question remains is if you're investing in gilt funds again, and if your time horizon is 3 to 6 months, effectively the bet you're making is that rates in India are not going to go up. Is it a fair bet? Look. Internationally, inflation is down. We have deflation in most parts of the world. We are importing deflation as well. One of the biggest causes of inflation for us is oil prices, and they are at multi-decades low, not at the lowest point that we have seen in the recent past, but still low. Gold imports have fallen down, so that also kind of helps us. So it's a fair bet to say that in the next 3 to 6 months, interest rates are not going to go up. Is RBI going to cut rates aggressively? That's also not a given, right? I mean, we think they should, everyone thinks they should, but RBI always has a mind of its own. So it's again, what you have to understand is that 3 to 6 months is a very short duration. And even though you're investing in gilt funds, the view you're literally taking is on interest rates in India. Are interest rates in India going to go up in the next 3 to 6 months or to go down in the next 3 to 6 months? In balance, is it a fair bet to say that interest rates are going to go down? I would personally think it's a fair bet, but do remember that, again, there is risk involved. it is still a bet on interest rates. It's not a sure shot kind of a safe investment, even though it sounds like one.
Yeah, that's absolutely true. I mean, it could be something where you are potentially losing out on returns. There is always that interest rate risk, that element that's there in gilt funds. Okay, we've received another query from Mr. Subramanian Pichai, and he writes into us saying that I've invested 5 lakh rupees in the HDFC Balanced Advantage Fund in 2018. This was a lump sum investment. Unfortunately, he's not mentioned if there are any other funds that he's invested in. Now, he wants to know, is it advisable to hold on? Is it advisable to start another SIP in the same fund, that's the HDFC Balanced Advantage Fund, or in any sectoral fund such as pharma or technology? I completely understand why he's choosing these 2 funds, because these are the 2 sectors that have done really well. And he also wants to know which fund is safer as far as capital erosion is concerned. So, of course, given the rapid depletion we've seen in NAVs, everybody is not just concerned about earning return, it's also about whether their capital has been safeguarded, what they've invested up until now in the funds. So, yes, HDFC Balanced Advantage Fund. Gaurav, what's your recommendation?
Sure. So, a couple of things. We don't know how old Mr. Subramaniam is and why he had invested in these funds. So I think it's very important to know why you have invested in a fund and kind of what kind of duration you were thinking when you invested in a fund. Just purely looking at how the fund performs vis-a-vis something like a Nifty 50 index, it's pretty much an index hugger. It's called the Balanced Advantage Fund, but if you look at its returns for the past 3 or 5 years, they're very similar to Nifty 50. So not very clear what the extra expense ratio that you're paying there is for, and also not very clear what kind of downside protection you're getting from having a balanced fund which has a debt in it as well. So, but again, it's important for us to kind of to make a recommendation is to know whether what's the purpose and why this fund was bought in the first place. We in general prefer index first investing. So we would always say that, if you have doubts, invest in an index. But if you have a fund in your portfolio and you think that the fund is meeting the objectives for why you had invested in, then start a SIP in the same fund. There is always a downside of having too many funds in your portfolio. That portfolio bloat makes it really hard to manage a portfolio down the line. So that's what I would say. So I know it's not a very clear-cut answer, but in balance, we don't see any balance advantage in the HDFC Balance Advantage Fund, but it does matter on why you decided on this fund in the first place and how long you were thinking of investing in it. So those 2 questions you have to revisit, and you have to kind of think through on whether you want to continue with this fund or not. If you don't want to do it, then index funds are always a good option to go with. The second part of the question was, I think, sectoral funds. Strongly, we suggest not to get into sectoral funds. If you think that timing the index is hard, and timing the index is massively hard, right? I mean, think about COVID-19 came out from the blue, right? Sector funds are a multiple harder than that. They depend on how the Indian economy is doing. They depend on how the sector is doing. They depend on how the sector is doing globally. It also depends on whether India has any sectoral advantage. Even if you look at IT funds, right, it's not like the IT sector funds have always outperformed the index. Most of the times they're not. Same thing is true for pharma. So don't get carried away by a lot of articles you read and they say, hey, this is positive IT, this is positive pharma, because they almost always say that after, not for pharma, but at least for IT and for infrastructure, they'd say that almost after every budget. They'll get a budget pop and then nothing happens, right? So sectoral funds, very hard to analyze, even harder to time. If you're bullish on a sector for a really, really long term, then you can probably think about it, but our advice always is don't venture into sector funds.
Do not venture into sector funds. It's extremely difficult. It's difficult to time the market, and sometimes it's also difficult to understand the implications of news on individual sectors. Yes, there have been cases where, we've seen great outperformance in the last 10 years by certain sectoral funds like maybe consumption and banking. But I mean, we don't know what it's going to be like for the next 10 years, and past performance is obviously no guarantee for future returns. So that's extremely important to understand as well. So, just like many of the other experts, Gaurav as well is saying a big no to sectoral funds. All right, let's take on board our next query. Joseph George has written to us. He says, as a new investor in the equity markets, can you suggest best yielding stocks for the next 2 to 3 months? Want to build a good 15 to 20 stock portfolio. Investment capacity is 2 to 3 lakhs. Want good returns for 6 to 8 years, where everybody does. And he personally feels the market will go down to close to 2007 to 2008 levels. That's global financial crisis levels. Now he wants 15 to 20 stocks in his portfolio. And he says he's a new investor in the market. I'm assuming he has another profession. He's not a full-time investor. This is, of course, only a part-time thing where he just wants to park his money. So any portfolio creation strategies that you would have for him, or would you advise him, since he any which ways wants 15, 20 stocks, would you advise him to opt for a mutual fund? What would you recommend?
So a couple of things I want to point out first, and this is nothing, personal, but if you look at how the question is constructed, right, you need 15 to 20 stocks that will do well in the next 2 to 3 months, but you want to invest 2 to 3 lakhs for the next 6 to 8 years, and you also believe the market is going to go down to the 2007 to 2008 level. So in effect, you want short-term great returns, you want long-term great returns, while expecting the market to actually go down to 2007, 2008. Quite a lot of very competing views in a single question, if you understand what I'm trying to say, right? So if I have to think about this, I would say, first of all, this whole idea that because the market is down, suddenly I can pick a 15 to 20 stock portfolio that will outperform or that will do well is a little bit misleading, because if you can do that, if you can pick a 15 to 20 stock portfolio in a down market that will outperform, then what is stopping a mutual fund portfolio manager from doing the same, whose day job is to do this, right? So this whole idea that because the markets are down, suddenly I need to venture into stocks, I personally do not get the logic behind it. This is almost like saying, hey, in a bull market, the fund manager will do a better job. But in a bear market, somehow, someone like me who has a day job doing whatever I do will have an advantage to build a 15 to 20 stock portfolio that will do better. Most likely that will not happen. It can happen for someone, of course, but most likely that will not happen. So our larger view always is that investment comes from saving, saving comes from income. You want to get rich, maximize your income. So spend all your time and energy in getting the biggest reward for the work you do, right? So do great work at your office, get your increments, get your bonuses, get, a higher salary as quickly as you can. You'll save more, you'll invest more, you will be wealthier in the long run. If you go by that, then why spend so much time trying to identify these 15 to 20 stocks when you are very unlikely to have any advantage over fund managers, over portfolio managers who do this day in and day out, right? And India is not an underserved market. We have 42 mutual funds. We have 300 plus portfolio managers. We have PMSs. We have AIFs. We have managed accounts, and all of them are trying to find those same 15 to 20 stock portfolio that will outperform. So the competition is severe for you to say that I can come in and I can identify those stocks. So our advice always is, go with something simple. Go with something simple and invest all maximizing your salary. You earn more, you save more, you invest more, you get rich faster. And it's always like that.
Okay, all right, fair enough. On that note, Gaurav, we let you go. Thank you so much for joining us and very patiently answering all those questions and queries that we've been getting from our viewers. We've still been getting them, but unfortunately we're out of time. But don't worry, we'll get your questions answered over the course of the week. So stay tuned, continue staying tuned to The Money Show. For now, we'll wrap it up.